I am not a financial advisor, and this is a podcast for informational and educational purposes only. The content discussed here is not intended as financial, investment, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Past performance is not indicative of future results. All opinions expressed are my own. Aloha and welcome back. Today we're going to be watching Market Update with Steph and Obi live here on the pod. Also, we're going to be commenting in the chat, and you can see behind me, they're about to get started. So let's get the setup going. Give me 1 second. All right. There we go. Perfect. Let's go. What's up, Quantum? Good morning, brother. How's it going? Hope life is good. Getting everything set up here. I don't know what's going on with my feed, but I'm glad you're in here. Thanks for joining. Cue that banger music, right? What's going on? Are they trying to start? Oh, here we go. Here we go. Here we go. Is there just no music on their end? Interesting. Oh, here we go. Here we go. We got music on. Nice. Right? Seriously, great day for all-time highs. It's always a good day when this show is going, I gotta say, though. Oh, we got Celsius earnings tomorrow, too. Oh, the TV's on behind me, too. Duh, hold on, I gotta turn that down. Right, chill vibes for sure. Open door today. Yeah, exactly. I've got some decent size positions going on for open, so, but I don't expect them to do super well. I don't know about Peloton. I just find them hilarious. It's just not my type of exercise. But open door? Oh shit, man! I don't know what we're gonna do with that. Because they're expected not to do well, so we'll see. I've got puts out anyway. They were real cheap. Because who knows? I mean, good companies have been getting slaps, so I can't just sit here and hope. Let's change the message of the day.
Hey, we're live. Welcome to Robinhood's
Let's
Monthly Market
go!
Update. I'm Michael Obusena, head of education here at Robinhood, joined as always by the lovely Steph Guild, Robinhood's chief investment officer. Steph, how have you been? What have you been up to?
Been good. I've been on the road. I just got back late last night. I was in LA for a couple of days for the, this probably needs to be a little closer to me, for the Milken conference. I actually got to see a bunch of different panels there. I was on a panel there.
Oh yeah, I'll get some
about
job options on
prediction markets
GLW for sure. I'm
and
gonna write
how,
that down right now.
you know, how I
Oh.
use it, or how it
Yeah,
can
yeah,
be
yeah, yeah.
used
Corny.
in decision making, investment decision making.
Yeah.
It was so fun, to be honest, because I think the best part about it was just like the people I met, especially the Monday evening event. And I also bumped into some old colleagues, like out of nowhere. Which is always the most fun.
Yeah, for those that don't know, Steph, before being at Robinhood, was, 20 years at JP Morgan, I believe?
Tiny bit more than that, but yeah.
Yeah, we'll call it the north side of a couple decades. Hello to everyone in the chat. Good to see you. Edsman, aloha, my friend. Mahalo. Hope you're doing well. We've got some old faces. Hey, we got Steve. Our guy Steve in the chat watching us from wherever he's at, as well as Luak. Good to see you, bud. Felipe, how you doing? You guys know the drill in the chat. For anyone new, Steph and I, we used to live stream every Friday, a show called The Week That Was. Now we're kind of pivoting to more of a monthly cadence, so glad to see everyone. Get your questions
excited
in the
about
chat.
that, if
Subscribe
you're
so
gonna
you
be
can
here
ask
for
us throughout
monthly.
the show. Later on, we're going to do some Q&A. But Steph, let's get to it.
We're gonna ask
On
today.
tap for today, as you mentioned, you were out at the Milken conference. You were going to tell us what you
cool
saw, what you
transition.
heard, who you talked to, kind of the lowdown there, as well as later on, we're going to be joined by a special guest, CNBC contributor and head of options interest.pro, Michael Coe, who gives us he's going to give us some clues on the options market. What is it telling us about this rally? And then, like I said, get your questions in. We always like to have a robust Q&A session. We'll get those on screen later. Before we get started, as always, just some ground rules to cover. Today's content is provided for informational and educational purposes only, does not constitute tax or investment advice, is not a recommendation for any security or strategy. Remember, all investments involve risk, including the possible loss of capital, so please consider your investment objectives and risks carefully before investing. Remember, past performance does not guarantee future results. And last but certainly not least, this live stream is not an official customer support channel, so if you got questions about your account, please reach out to our support teams from within the app. They're ready and waiting to help you. With that, Steph, let's jump right into it. You mentioned you were out west. For those
Quantum,
unfamiliar with the
question up
Milken
there.
Institute Global Conference, this is kind of a big one. CNBC's out there all week doing interviews with
Bloomberg, all of them.
Yeah, saw interviews with Ken Griffin from Citadel, number of different CEOs. Take us through it. What is it like there? And more importantly, what's the consensus among the quote-unquote smart money, and what are they seeing in this market?
I think so. It's just filled with people who are into markets, into different topics. The setup is really actually hard to see everything because they put so many good topics, but they put them at the same time. So you'll have like 5 or 6 different panels or conversations that you can attend. and they'll all be at the same time, and they just have blocks of time going down. So it's like this grid, and you have to just pick and sacrifice going to other ones if two things you want to go to are at the same time. The first evening, though, closed with, you had your choice of either Jensen Huang or Tom Brady.
Yeah, take your pick.
So you had to pick your I don't want to say poison because it's not poison at all, but you pick your area.
Choose your adventure.
Yeah, choose your adventure. The first one I went to, there was a bunch of interesting speakers on the panel. His Royal Prince Alawid was on it, and there Jenny Johnson, who runs Franklin Templeton, and the CEO of Chevron. And the biggest thing I think one of the things I took away from the conference, this is not just about listening to the CEO of Chevron and others, but it was also an evening event I went to on Monday night that had a couple of people who were just like people I started chatting with, and they just happened to either be in the energy markets in the Middle East or happen to be in the energy markets here in the US, and maybe don't do that anymore, but have a lot of awareness of it. And the one thing that this, when you're listening to these things, a lot of them are live streamed. Actually, a lot of the big ones are. So I feel like you're not necessarily going to hear anything like you wouldn't hear if you watch them on CNBC. The CVX CEO, though, because the one thing that's been on my mind, I'll tell you, in this whole bull market has been commodity space, and particularly the oil markets, and the huge difference in pricing between the physical oil market and the futures oil market. They're actually just not the same. And the futures oil market is actually much lower than the physical, because the physical is where like the actual supply constraints are. The futures market is a trader's market. So the CVX, CVX is the ticker, Chevron is the CEO. He said, last week we threw out our best case scenario. And so that to me just kind of said something, like they're like, it's either like an okay scenario or their worst case scenario. And then later that evening, I was chatting with some of those people that I mentioned, and I said, I don't want to curse, but are we bad or really bad? And they all agreed that we were really bad, because even if everything, which it doesn't, it keeps going back and forth as to whether things will end right away, but even if that happened, it would be no less than, it would probably be at a minimum 3 months before you started to see any kind of recovery in supply from the things that were damaged and closed up, because they said there's actually no storage in the Middle East at all. And so the fact there's no storage just means, like, if you can't put it anywhere, you just don't pump it.
Yeah.
And so that's like I think that's meaningful for a lot of things. It's meaningful for helium, which goes into chips. It's meaningful for our food because of fertilizer, all the things we've been talking about. So that's the one thing I just feel really good about having some commodities in a portfolio, still to this day. Another thing that I took away is an area that
I'm trying my best
really
here, Quantum.
Enjoyed learning more about, and the
if I can get
algorithms
you
have
guys
found me
access,
in this,
I will.
which is
I'll do my very damn best.
just GLP-1 drugs and peptides.
Because you need it, bro. Like, you would
the
be
picks and
great
shovels
for
of
showing off
peptides.
the great stuff that you're doing.
I listened to this
everybody
one
could learn from you.
healthcare panel that I have some notes in front of me, but a lot of them were saying, like, we need to.
I'm not sure. I don't have one.
That they were saying that, like, trials are really, really expensive, and so getting funding for trials is so important. But they said, like, to them, the next wave, besides peptides, and if you've listened to any podcasts on this or anything, like, you'll know that there's a lot of doctors discussing the fact that, like, there's a huge amount of amazing peptides out there that are not being allowed to be out there because the pharmaceutical companies can't patent them. Mm-hmm. And so they if they can't make money off of it, they're going to make it hard to get them out there. So they were talking about how, like, some of these peptides truly can, like, reverse and slow down aging. And then they said the big thing that they are focused on is the brain and brain health, and how we know so much about our heart health and other things, but we don't know enough about brain health. And so they think everybody should go get their lipids tested. They had a couple of recommendations at the end. They were like, obviously, like, exercise, set an alarm clock for your bed, your lifestyle is just really important overall. Take B and D vitamins. This is not an investment recommendation. And then get your lab tests on your lipids, because they said, like, the same way that we know our LDL and our HDL and our cholesterol, like, you want to do the same thing for your brain, because that's actually going to give you a lot of really good information to understand what your risk factors are when it comes to your brain. And they said, with all of this stuff, if this starts to happen and we start to have like good clinical research on brain proteins, this one woman was like, there's going to be a paradigm shift where people are living longer, and it's actually going to have a financial strain on the world. And they said insurance companies, pension plans, like, they're not going to be able to handle the increased span of life. And also she was very positive on productivity as a result of it. So I came away pretty positive long term.
Yeah.
But I do think that question of, in the short term, does the market already have a lot of the near term profits in it? And I think you're seeing some of that in the earnings and some of it not. It just kind of depends on the name. So I continue to be bullish, but near term a little bit neutral.
Yeah, I think, you know,
I can see that.
what a lot of people don't realize, like, at these conferences, you get some of the smartest people in the world in a room for a few days, and
Something
you
cool
don't
comes
talk
out of that sometimes.
directly about the market. You talk about the future trends of the world and population, and what you're describing in terms of, you know, healthcare changes. It's like when you get those brains in the same room, like the ability to sort of have a somewhat of a crystal ball into the future of humanity, and then narrow it down to how does that impact day-to-day life, financial markets, you know, strain on systems around the world. It's a very interesting conversation. So whenever you see stuff at like Milken, Davos, or any of these sort of, I call it the master of the universe meetings, where they all get together and sort of, you know, plot the future of humanity, it's you can have some really cool takeaways.
I'm gonna need to see where Obi
Can I
got
tell
his
you one
shirt from.
more?
Yeah, sure.
I just happened to start chatting with this very lovely woman again on Monday night. And I said, what do you do? And she's like, I run a space company. And I'm like, oh, tell me more. How did you get into that? It ended up being Bridget Mendler. She runs Northwood, which is like a Series B space company. They actually make the communication system so that anyone in space can talk to Earth and vice versa.
Oh, that's badass. I'm gonna invest in that.
I mean, her background, she was like, at the end of our conversation, she's like, tell me about you. I'm like, no, I'm not nearly as impressive as you. But I went to her panel, and I really like this space thing is like, I mean, I just think it goes along with one of the themes that I am starting to say. It's that everything is really old in our country, like our electrical grid, our, you know, we haven't invested in space anything since like basically the 1980s. So she's like, we're redefining, you know, that, and we're manufacturing in California end to end. And of course I was like, what commodities go into that? Like, are you worried about that? But we're, you know, it's really like another super interesting, like, I just feel like it's a really amazing time for that.
Yeah, and our former co-founder Beju Bhatt is doing something in space.
I asked her if they knew each other. She's like, oh, you know Beju? I'm like, I do.
Yeah, we kind of worked for him. Steph, let's bring in our special guest.
Yes.
You know, we last time we did this,
I
we
gotta
had Bob
figure out what question to ask.
educating us on the oil markets. This time we have a wonderful
Honestly,
guest.
I just
who
don't have
we,
one. Not
met
right now.
and had at Hood Summit last year as well. He's a CNBC contributor. Currently was on Fast Money last night. Will be on Fast Money again tonight, so you can see him later today on the show. As well as a former co-host of Options Action on CNBC, a place where I got to learn a lot about options back in the day. He's Michael Coe, founder, chief strategist of OpenInterest.pro. Mike, how you doing, bud? Good to see you. I see you're in New York. You've got the hotel room shot, looking great.
Yeah, what a great backdrop, right? So, yes, sitting here in a Manhattan hotel room. I actually have an office down by Bryant Park, and I was going to head down there and do this from there. But you know, we were trading some messages, and actually I was looking at some things in the energy markets as well. You didn't.
Yeah, maybe he should have actually went down to his office. He looked shit.
Started my career trading oil service index options on the Philly. So yeah, I have quite a lot of experience in the energy markets, and And so it was interesting to hear Steph talking about that.
Timely topic indeed. Let's set the table here, Mike. Can we bring up the chart? I've got the S&P futures up, looking back all the way to last April. I don't know, guys. It just seems to me like if you're a medium to longer term trader, you're going to get these setups where there's this sort of geopolitical noise that happens. We get taken to the brink of something, and then you're just waiting for that, not a tweet, true social post, whatever communication channel you want to pick, and then the market just ignores it, and we're back to the AI trade. It seems like this AI trade, Mike, is so powerful that even though we get some distractions that sort of put us downshift a little bit, once those kind of uncertainties are gone, or at least mitigated, we're back off to the races. On this chart here, we've got the tariff pause, we've got the ceasefire announcement. And then this line here, Steph, this is when we were last on air, last month in April. And since then, it's just been up and away.
Parabolic.
Yeah. Mike, talk us through this move. What are you seeing? How are you interpreting this? And how strong is this AI trade?
Well, to understand how strong the AI trade is, we have to understand how big it is. And I think it's sometimes hard for people to appreciate because we become pretty easily anesthetized to large numbers. When we think about the scale and scope of this,
the episode with the two Michaels,
the second largest specific industry investment boom since the development of the railroads in United States history.
Do we got CC in the chat?
To help understand that, just consider that the U.S. GDP is, probably 31 trillion, give or take, for 2026. Round numbers are sufficient for this exercise. And just the major hyperscalers CapEx for this year, because you'll remember after Alphabet/Google, I still go by Google, their CapEx, they actually ramped for this year to just shy of 200 billion. So between them, it's $1 trillion of CapEx. It's 3.3%, give or take, of US GDP, just on the hyperscaler side. It's hard to overstate how big that is. And the other thing I think that's kind of interesting is because people, when we look at the markets, what people typically look at is the S&P. That's, I think, how most of us who came from an institutional trading background, we think of the SPX index, we think of the S&P 500 and the CME big contracts on that. But quietly, there's actually been a bit of broadening in the market as well that I think probably is getting missed. Old economy types of things. So if you take a look, there's an index called the Dow Jones US 100 Dividend Index. Kind of think of it as like the dividend aristocrats. There's a lot of old economy stocks. I like to joke that in a geopolitical environment where people are getting very panicky because you're worried about what's going on in the Middle East, and this is material. I've followed the traffic through the Strait of Hormuz quite considerably. We went from 93 ships a day to 7. Of those 93 ships a day that we're typically going through there, 56 were tankers going in and out, transiting with about 20 million barrels of crude. That's 20% of global consumption transiting that strait, and it basically got shut off. Every $10 increase in crude is probably 10 basis points to global GDP, so that's a meaningful impact. But quietly, some old economy stocks have actually really rallied. And they trade at much cheaper multiples as well. And I think part of what might be going on there is that investors are beginning to recognize that this is not simply about the companies that produce the hardware that is going into this trade. It is also about potential productivity improvements that legacy industry might actually get from all of this. And then quietly, you also have a couple other sort of beneficiaries of the geopolitical tumult that are regional. So in energy markets, you have a lot of what's called basis risk, which means that it's not just about the price of the commodity, it's about the relative price of the commodity in one place versus another. North America, we have a lot of natural gas. It's not as easy to ship as oil is. And so our natural gas prices are much, much lower than they are in other places, about a fifth of what it is in Europe right now, which means that if you're worried about, as Steph mentioned, things like the FERTs, North American producers suddenly have a huge local cost input advantage. CF Industries, companies like this that produce fertilizer and natural gas is a big feedstock. If your cost for the input commodity is a fifth of what everybody else's is, that's a big leg up.
Yeah, looking at the chart of natty gas here, this is the June contract. Obviously, we had that big spike in the winter. It was a pretty harsh winter for everyone around the country. But to your point, Mike, everything kind of trading back. We're seeing, trading near, kind of the lows of the last year. If we go out a little bit farther, take a look at the 5-year chart, kind of sitting above the 5-year lows, but still nowhere near the highs that we saw, back in 22, as well as the spike this winter.
Are you looking at the U.S. Henry Hub gas contract?
Yes, this is NG. Yeah.
Yeah. So that's one of the things I used to trade. I was in a Henry Hub pit on the NYMEX. If you looked at the Amsterdam gas price, it is 5 times that.
Yeah,
number.
I was gonna say, because they don't have access to it, right?
Exactly, because we can transport some. Big beneficiaries there on the transport side are going to be companies like Cheniere, because what you do, of course, is you liquefy natural gas and you ship it. But we don't have the capacity to make up what has been lost. And there was already massive losses anyway, because this is the second enormous geopolitical concern that's affected energy markets in the world in the last several years. Because if we go back, we'll remember that Russia invaded Ukraine, and we don't know exactly who did it, but there were some Ukrainian officials who were implicated, and they sabotaged the Nord Stream, which was a key natural gas pipeline to Europe from Russia. So they've really taken it over the course of the last 6 years. They've seen their natural gas prices absolutely skyrocket. It's a real challenge for Europe, and the oil disruption is a big challenge for things like jet in Asia. That's a 6,000 nautical mile trip from the Persian Gulf through the Strait, through the Gulf of Oman, all the way to, for example, the refineries in Singapore. And that's why they were canceling some flights, actually. That's how big the shortage is. And those ships, at best, are running 15 knots. Think about this also, 60 days of at least a 10 million barrel a day disruption, plus the fact that the US SPR alone was 400 million barrels shy. That's 1 billion barrels of crude oil that we need to make up.
That's a lot of crude.
So I don't know what the CEO of Chevron told the Steph, but if you think that crude's going to go back to the 55 lows in WTI that we saw in mid-December, that ain't going to happen.
No way.
No, and that's
not
very
anytime
much
soon.
in line with the things that I heard. Not only, the CEO of CVX, who basically just said we threw out our best case scenario of replenishment.
We
but
gotta
it
get
was
that
all
lady
those other
trader
people,
on
like,
from
who I won't
Robinhood
name,
Summit.
but who were just
She
like,
traded
it's
primarily
gonna be,
crude oil
and
futures.
this is the thing. I did hear somebody
from
on Bloomberg
Vegas.
who was at the conference, but I heard him just on a Bloomberg clip. I think they ran energy for, for Obama. Anyway, they said, the physical market is reflecting what's actually going on. The futures market is reflecting, just the trading market. And they said they have to converge eventually. And so either the physical market drops in price or the futures market rises. And which side are you on for that? And to me, in the near term, based on what I heard, it was that it would rise to the physical level, if the futures market would rise to the physical level. But I'm curious, like, it'll be a big deal if you get the
So it's gonna be both. So, one of the things that commodity traders will often tell you. So just for everybody who's watching, who's thinking, okay, what is this that we're talking about, the futures market? Futures go out quite far in time. Oil futures market isn't as much a retail product as it is. It's a speculator's place, and it is also people who are in the industry that are going to be trading that market. And that's because these contracts are fairly big. Natural gas contracts have a 10,000 multiplier, crude's 1,000. The product contracts are actually the same size, although the unit is different, because you'll see 42,000 for like a gasoline contract or a heat or diesel contract, but that's because it's 42 U.S.
Obi
barrels,
got the new stuff on.
42 U.S. gallons to the barrel. So the 42,000 is the same as the big contracts in crude. So when the spot prices for a commodity are lower than the futures, that's the normal circumstance. And that curve, we will say, is in contango, right? And the reason that you will typically see the longer dated futures trade at a slight premium if everything's in balance, and the energy markets have a lot to do with balance, especially lately. People have heard of just-in-time delivery. This is a market that works a lot like that. It sort of depends on, there are shock absorbers built into the system all over the place, because the supply chain, the logistics actually contain a huge amount of capacity, but that's largely been exhausted. So that when the futures are higher, they're higher because they reflect the cost of capital and they reflect insurance, transportation, and other costs, right? So you would expect the futures to be above the spot price for physical. That's not where we're at right now, not by a long shot. Right now, we're in a shape of the market that's called backwardation. That's when the physical markets are trading at a big premium to the futures. So instead of the curve being upward sloping, it's downward sloping. That's generally thought of, once a curve inverts, that is typically thought of as bullish for the commodity, because what that reflects is that, and this is economics 101 here, that the supply-demand imbalance has become severe and that the supply is insufficient to meet the near-term demand. And that's exactly where we find ourselves right now. And that can be very local. And that's the basis part that I'm talking about, that, which means that the price of oil in Midland, Texas is not going to be the same as it is in Singapore,
Right.
simply because it's just, there is a big logistical challenge getting it from one place to another.
Yeah, if we could bring up the screen, guys. This is my latest iteration of Robinhood Legend that I've been messing around with, doing some
Looks great,
beta
Obi.
testing with the new Cortex scripter. So I've if you guys remember,
What
like
the
Edsman
heck
and
is a
everyone that's
corpus?
seen my futures charts, I
What
finally
the heck
got
is
these
a corp-
scripted.
what
As
the hell
opposed
is a
to doing
corporate
drawings. So
cor-
I did
Cortex
some
scripter?
testing there. But if you look over in the right-hand corner, we have just a watch list. And to point out Mike's point, we did this last live stream with Bob Icino. We've got the crude contract for June, July, August on our watch list, and you can see the price is going down. 92 for June crude, 89 for July, and 85 for August. And if we had the spot price, which we don't have on a watch list, but I assume it's much higher than 91, so sort of you can see that futures curve just by putting it on a watch list on your Robinhood Legend.
Wow.
Mike, in addition to the energy markets, we've got some options data that I want to go over with you, and then we'll start our Q&A. I see a lot of good questions piling up. Keep them coming, guys. In a bull market like we're in, this sort of parabolic move up, this melt up, you can glean some information from the options market even if you're not trading options. Take us through what you're seeing. Explain some of the concepts like options skew, and how do you use sort of volumes around calls and puts to give you a perspective on the market, whether you're trading the options or not.
Sure. I think I'll start with the last part of that question first, because for those watching, I'm sure most of you know, a call simply gives the purchaser of the call the right to buy the underlying asset at the strike price for an American-style call option between now and the expiration date, and a put gives the purchaser the right to sell the underlying asset at the strike price, same thing. Because of this, most people think of the volumes in calls and the volumes in puts as naturally indicative of the sentiment of those who are initiating trades, which is to say, oh, well, call volumes traded 2 times as much as put volumes. Therefore, options traders are bullish. And the opposite might also be true. You can say, okay, well, puts have out-traded calls, so therefore that's bearish. A more nuanced way to think about it, though, is that because an options trader can either initiate by buying or selling those options, a better way to think about it is to say, okay, well, there was a lot of call volume, there was a lot of put volume. Was the initiator purchasing or selling those options?
Oh, yeah.
Examples where people could be bullish. You could buy an underlying stock and say, you know what, I want to harvest a little bit of extra options premium, so I'm going to sell calls against it. Well, when you think about it that way, you recognize that you could have a lot of call volume, but it isn't bearish because people are buying stocks and selling calls. That's moderately bullish. So sometimes a better way to think about the sentiment of the options market is to look at the relative prices of puts to calls. And when we talk about skew, that's exactly what we're talking about. So what is the price of a 10% out of the money call relative to the price of the at the money options and 10% out of the money puts? And, before we went live, I was actually just taking a look. Okay, well, where are we now? Because some people might look at something like the VIX and they'd say, well, the VIX is down quite a lot. And
like 16
what
right now?
we're thinking about when we talk about skew is, well, those 10% out of the money calls in the S&P, are they higher or lower than they were 2 weeks ago? Or, we're seemingly coming out of some of the geopolitical risks. are they higher or lower than they were 3 months ago, which is before the strikes on February 28th? And the answer is that the call options, 10% out of the money call options in the S&P right now are higher than they were 2 weeks ago. They are higher than they were 3 months ago. 10% out of the money put options, by contrast, are not only lower than they were 2 weeks ago. That would make some sense, right? Because we're seemingly going to see a little light at the end of the tunnel, but they are actually lower than they were 3 months ago. So 10%
I've
out of
always
the money
got
put
generic
options on the S&P
Viagra on
are
the back
cheaper
screen.
now. Demand for those is lower now than it was before the strikes on February 28th. I find that interesting.
So do you interpret that as maybe we think this move is starting to get exhausted, or is it just people are starting to sell that premium because it's getting so rich on the upside? Like how could
Brother
got to
watch that TV in his hotel room.
Decision-making process.
The way to think about that is, and this is on decent volume, right? So we trade about 70 million contracts in options land on the average day. Again, I'm using round numbers. It's slightly higher than that. Lately,
Heads
over
up,
the course
guys.
of the last
QR
20
code
days,
for
about 40
generic
million of those
Viagra there
calls,
on the
30
back
million
screen.
puts. When you start to see that tilt, when you start to see the bid for upside calls increase and the bid for downside puts decrease, that says
Not financial
to
advice.
folks, look, investors are becoming sanguine, or a more alarming
Complacent?
term. Yes, you got it, Steph. That's where I was going. So it is safe to say that investors are becoming more complacent, and that can be a contrarian indicator.
I'm glad you brought this up because I was going to bring it up. I saw a post on X from Zero Hedge, and they said entire market is now one giant gamma squeeze. He traded at 2.6 trillion notional of calls yesterday, all-time high. Want to get your reaction to that?
Yeah, I mean, one of the, it's true. So when people talk about the notional volume, and in case people are watching, like, what's notional volume versus volume? Volume is just simply the quantity, the number of units of something that trade. The notional is when you factor in how much each one of those units is worth. So if I'm dealing with a stock that's $1,000 and it trades 1,000 contracts, that's a lot bigger than if that stock is $100 and it trades 1,000 contracts. So one of the interesting things is that volumes have gone up. They've continued to rise. We're not at the all-time highs. We saw actually the all-time highs volume-wise in Q4 of last year, but we are very, very close. And then you combine that with the fact that stocks are at all-time highs, which means that the amount of money that is being, trading hands each day in the options markets would also have to be at all-time highs, because you're almost at the peak volumes and the prices for everything are as high as they've ever been. So you put all of those things together, and that's why you see that. But, as I was saying before, when I was talking about the Dow Jones US Dividend 100 Index, which is all of these old school companies, another way to think about how complacent people are is, what are they willing to pay for a dollar in the future? In other words, if you're willing to pay 30 times forward earnings or 40 times forward earnings, you're obviously more exuberant than somebody who's not willing to pay more than 20, a 5%, earnings yield, which is what you invert the PE, and that's essentially the corporate earnings that you're going to be getting as a percentage of your investment. So in old economy type stocks, Kimberly-Clark's, Procter's and Gamble's, as a group of dividend paying stocks, those are trading at about 14.6 times forward. Despite the fact that actually the top line revenues for those companies over the last 5 years have probably grown faster than most of the S&P, excluding, the Mag 7. They have not seen the same earnings growth. They've actually had margin pressures in those businesses. But I think that investors should probably be looking more at those types of things. First of all, when you're getting distributions back, that's generally going to be thought of as a lower risk investment. If you're talking about companies that are mature and you're paying a lower return for them, that's shorter duration. So I don't think that investors should pull back from investing. I think they just might want to broaden what they're looking at.
Diversify.
Yeah. Last question, and then we'll get to Q&A. Steph, we're sort of we're through most of earnings season, with obviously retail coming up next week, and then the big one with NVIDIA in 2 weeks. How would you give earnings season if you were to give it a grade? I assume it's going to be a good one. Markets have rallied pretty strong on stuff, but what are you seeing in the earnings reports? And then after that, Mike, what should we be looking ahead with NVIDIA in terms of option pricing implied moves? Steph, you first.
Yeah, I mean, look, expectations were for this past quarter, they were for 14% at the start of the year.
Wow.
They got to 21%, and I was just going to look at so far what the earnings growth is 28%. What's actually happened. So I mean, it's like an A plus quarter, I would say. There is one thing that I caught someone saying this morning on X or last night on X, I can't remember, but, and it's just kind of like been sitting in my ear, is that if there's an expectation that commodity prices are going to go a bit further, even if we end up having like a complete ceasefire and the Strait of Hormuz opens up, this has implications throughout the economy. And has there been any buying in anticipation of that? The same way there was buying in anticipation of tariffs last year. And so I just have that in the back of my mind, that was there increased demand pulled forward in these earnings. But no doubt that earnings have been spectacular. As you know, my phrase, expectations are everything. So there were some names that just had such high expectations that, the stocks just didn't rally. They actually tanked after earnings. But in some cases, I think those were buying opportunities, and some of them actually did come back after that. But the other thing I would just say is that, like, these moves are so abnormally big to me. Good earnings,
Thank
you're up
you.
double digits.
I'm glad
Bad
somebody
earnings,
said
you're
that.
down double digits. Like, it is just, there is no
Jeez.
room for anything really in between. Because even if you just meet expectations, a lot of the stocks just go down anyway, because I think there's just a reaction like, oh, they're not actually growing faster than is already discounted in the stock price. So that to me is wild. And then, so for this full calendar year, expectations are now almost 22% earnings growth for the entire
Jesus.
year. And the long-term average is more like in the 8 to 10% range. So these are really high numbers. So you just have to think, like, as the year goes on, you want to say, okay, what is 2027? What's expected there? And right now it's still 14%, which is not low, but it's not 22%. So you have to kind of start thinking, like, do I think that earnings growth can be the same as this year, or will it actually be 14%? In which case the market is starting to look a little expensive. So you kind of have to think about that. I do also think that this year's expensing, the ability to fully expense any of your CapEx right away, is definitely providing a boost to earnings.
Yeah, Ed's been using your line, expectations are everything, and they were, at some point you raise the bar so high, there's a natural, like,
You
did
gotta
great,
come
but
down.
you didn't do good enough.
Yeah.
Mike, last question, we'll go to Q&A. We've got NVIDIA earnings on May 20th. I've got the option chain here if we want to bring that up. Looks like right now the expected move for the options expiring May 22nd is, we'll call it just
NVIDIA at
plus or minus
212.
$25.
Wow. Staying
We'll just
above
round
200.
it,
That's nice.
which is a little bit over 10% implied move in the stock, trading 212. My biggest question for you, and I know we have a lot of options traders probably watching, a lot of traders, newer options traders here at Robinhood, and their inclination is, I think the stock is going to go up. Let me buy some calls going into earnings. Why is that potentially a perilous path for someone, especially when you start getting that IV juiced up, not just for earnings, but for this AI move in general? How would you teach that to a new options trader, Mike?
Yeah, there's two things I would say about it. First of all, when you buy an option, you think about this. I mean, an underlying asset, stock, commodity, whatever, there's really three things that can happen between now and some future date. It can go higher, it can go lower, or it can do neither, basically go sideways. If you buy call options or put options, and if you buy options just generally to make a directional bet, 2 out of those 3 isn't going to turn out well for you. If I buy an upside call in NVIDIA, if the stock goes sideways or lower, I lose my premium. Now, that doesn't mean it's not worth buying options at any given time, because sometimes if you're willing to make a bullish bet, buying a call option is a lower risk way to do it, because you could say, well, I'll only make money if it goes higher, but I've defined the amount of risk I'm taking if it goes lower. So that's one of the reasons why I think it's very attractive for people to use long options, whether calls or puts, going into catalysts such as earnings. But as you point out, options premiums get elevated going into those events. The options markets are pretty good predictors of how much an underlying instrument can move around. And so what ends up happening is that event variance, that's what we derivatives traders call that. That's the additional premia that is built into a derivative that captures more than just the underlying volatility process, gets elevated. And of course, once that event comes out, it comes right back out again. We call that vol crush. So you might have, options in a stock that trade, and we don't need to get into the complexity of it, but at an implied volatility of say 30%. So that is just an options trader's way of thinking about how much an option is worth. In the normal case, go to 50%. So significantly higher if it's going to capture an event. So really, you have a very high bar. It's not just that you have to be right. You really have to be right if you're simply going to buy calls or buy puts to make directional bets. There are things you can do to mitigate this. You can trade spreads. You could say, okay, well, I'm going to make sure I choose a call option that is close to where the stock is currently trading, and I'll sell an upside call against it to mitigate some of that vol crush effect. So it isn't basically the home run that you're swinging for if the stock went up, say, 20%, which is much more than the options market is expecting and would be quite ambitious no matter how you think about it. But you reduce basically how high the stock has to go before you at least break even.
Wow.
And start to see some profit. So that improves your probability of profit. But there are other things you can do too, which is, you could actually sometimes sell options. If you find a stock that you want to own and you have sufficient capital in your account to purchase it, and you think that options premiums are expecting a move that's larger than you anticipate, sometimes it makes more sense to sell options than to buy them.
Yeah, and I want to bring up a comment in the chat from our Armenian Muscle. Earnings are a pure gamble, nothing more. It is ticker agnostic. Doesn't matter what the ticker is. Playing earnings is always rolling the dice. And I would take the other side of that trade, Armenian, in the fact that, the way Mike just explained it, anytime you buy options, you have a theoretical less than 50% chance of profit. And that's just the way the option pricing works.
Oh.
However, if you become an option seller, you understand implied move, understand strike selection and where to sort of, what is being priced into the move relative to what the realized move is, you can turn those probabilities in your favor. So while there's never a guarantee of profit when trading or selling options, if you don't like the odds of a 20% probability of profit by buying an out-of-the-money option, we can sell a spread. Like if we're still bullish on NVIDIA, we can sell a put spread. If we think it's going to stay within the range, we can sell an iron condor or something like that, an iron butterfly, and have a theoretical probability of success of closer to 70 or 80%. It doesn't mean you're going to make money, but it tilts those odds in your favors. And when you start doing the law of large numbers and you place a good amount of trades, over time, theoretically, like those odds should come in line. And it's all about, at that point, trade sizing, risk management. So I take your point, but I think there's another side to that. With that, guys, let's get to our Q&A. We got a couple questions lining up. I see some good stuff in the chat. Starting with our good friend Quantum Queso Dip.
Oh, here you go, bro.
Question, Steph, based on your latest Investors Guild, do you think demand for AI infrastructure will be outpaced by future supply of infrastructure? And I actually saw some good
I like the
comments in
new
the chat from
question
someone that
look, too.
works on
The
road
font is nice.
infrastructure,
That's nice.
with a good analogy. But Steph,
I'm digging it.
What'd they say? I'm curious. What'd they say?
let me find it. The chat's scrolling, but it was from Dan Jeffers, 2711, and they may have already been chatting ahead of this, but I work in U.S. infrastructure, and the data center boom is just getting started. Think of data centers like giant car parking lots, and our transmission infrastructure like highways.
Wow,
our
that's a
lots
good way to
are
think
built
about
with
that.
the best concrete and tech, but our transmission is still like dirt roads. That's why NVIDIA gave them billions to develop AI RAN. I assume is that the Corning deal that just got announced?
Oh, there's your company, bro.
For the
that's
fiber transmission, maybe.
part of
We're
it.
missing the start of this conversation, but
Okay.
what do you think?
GLW.
No, that's interesting
Corning,
to hear.
interesting.
Thank you, Mr. Jeffers. I think, yes, I think the plain and simple answer is yes for now. And I think the reason is because our infrastructure is is dated and old, and in order to be able to support it, there's a lot of things that we have to either build or come up with. And there are certainly a lot of companies trying to come up with more efficient things. You've got companies like Bloom Energy, but you still then need places to store energy if you're able to do it in a more efficient way. And our grid infrastructure is really, really old. And you can see that recently the White House put out an executive order that said that a lot of our electrification and our grids are really a part of national defense now. And they're under the Defense Act of 1952. And that means that they will get easier funding. And that's what we need. I think our entire country infrastructure is old. And so I do think demand will continue to be there, not just because of data centers, but because we're still a growing population, and the combination of those two things just require an enormous amount of infrastructure. And so, yeah, I think the supply will be a little slower than the demand.
Next question comes from our good friend Luwak. Any thoughts on the Fed share situation?
Nice question.
Mike, I'll start with you, and then Steph, I'll kick it over to you. This is back to our favorite show, As the Fed Turns.
As the Fed turns.
We've got some.
Wait, did you see his exit? It was my favorite.
It was, yeah.
When he was like, "Well, you're gonna keep a low profile," and he just ducks, and I'm like, "Oh my God, I love you."
Mike, what are your thoughts on the current state of the Fed as Chair Warsh eventually makes his way in, and what kind of drama do we expect to see over the next few months?
I feel like Washington, things that would normally just have been a simple transition, there's just a whole lot more excitement that surrounds it. But that news cycle stuff, I don't know that we need to get too fired up about it. I have a lot of respect for Kevin Warsh, right? So if you take a look at the body of his work, we've seen some real missteps in monetary policy. I don't think anybody who's had to buy anything recently recognizes that there probably should have been more on the basically the stability of the currency mandate portion of their responsibilities. And he was in support of some of the monetary policies that took place in the GFC, which I believe were needed, and he was less supportive of some of the things that followed, which I think there was a feeling within the Fed that, hey, we've gotten this cheat code. We started printing a lot of money, and it didn't really seem to have any downside. We can have low rates, and we can have a great labor market, and we don't get big inflation out of it. And so it was used much more aggressively in periods when it should not have been, and he was highly critical of that. So I think when I think about how he looks at this, I have some faith in his policy decision-making and experience.
Steph, your thoughts on the next moves for the Fed?
If you look back at the last few changes, the market always had a little bit of a hiccup when someone new comes in. I do think that what's happening in the markets today are kind of way more separate from the Fed. And interest rates used to be much more important input. And I think they're just kind of stuck in this higher range because there's a lot of competing forces keeping them there. The one thing I do think I think what this is just in general, that a lot of appointees by the current administration are there to be somewhat disruptive. And so I think he wants to be not necessarily disruptive, but change what has happened in the past for the better. But I think sometimes that does require some pain. And if he wants to lower the size of the Fed balance sheet, which I think is something of interest for him, that does require a bit of pain. So the one thing I wonder is does he say that and then get there and say, oh, this is really hard. and I might cause maybe too much ruffles for it. So, which I think happens a lot when, kind of politicians come into power and they're like, oh, actually there's sort of reasons for why these things haven't been changed. So, but I would longer term be supportive of that because it just gives the Fed so much more flexibility in how they can help the economy continue to grow.
Yep. We shall see. It'll be an interesting first presser, and I can't wait for your nickname for Warsh. Mike, Steph had an affectionate nickname for Jerome Powell, DJ Pow Pow, as he
Yeah, we gotta
played
come up with
the
a name.
market.
The market's DJ.
Yep.
What worries me about Warsh is that his name could rhyme with some things that nobody wants to hear in financial markets or maybe any other. I will make one quick point about on the rate side is that what we think of as low has completely been perverted by the GFC.
Yes.
If you look at basically the 10-year rates post the Korean War through 2008, the levels we're at right now would have been all-time lows.
Yes.
For a half a century, the rates we're at right now would have been all-time lows. It is only since that time that this craziness where we saw ZERPs, where we saw 10s go down to 50 basis points, where booms traded negative. That's
it's just
well,
not real.
all of it was negative in a real term.
Yeah.
Right.
But that was ridiculous. I don't think we're going to go back there.
Yeah. I mean, our parents and grandparents were paying what 20% mortgages, and it's a whole different world. Good to see our friend Dan Manon in the chat. How you doing, Dan? Next question from Sue Sound System. I love that name. Asks, does all this data center and chip demand mean we should be bullish on silver, copper, or any other commodity for that matter? Mike, I'll start with you, and then Steph, I know you talked about commodities earlier.
Sure. I think definitely, first of all, the industrial metals, things like copper in particular, I think there's going to continue to be demand for that. I think there's also going to continue to be demand for the precious metals, not just simply for industrial use, because gold actually has industrial uses as well, and not just making jewelry. It's used in heat shielding and electrical connectors, and has a lot of important utility. But I think the things that have been driving them, and also that's going to be propelled mostly by big money flows from things like central banks, and central banks have largely been net buyers. And it used to be that a big net buyer of things like gold and precious metals would come from the Middle East when oil prices were high.
No idea what chart this is.
And gold prices and silver prices low, they would be buyers. And when the opposite was true, they would become net sellers. That part was not true. They did not become sellers of precious metals when West Texas got to the mid-50s in mid-December of last year. They've continued to buy regardless of the price of oil. And so when I look to, and also don't forget about things like rare earths as well. I mean, so I think the mining story is a strong one and it's going to remain that way.
Yeah, Steph, I got this chart of silver up here, which was a little bit different than the chart of copper, which copper seemed to have a somewhat
copper.
normal move up. Silver definitely took the elevator to the top of the building, getting up to over $120 an ounce. This is
there is a squeeze.
Yeah, and then it can't. When we talk about silver as a tradable commodity, we've seen a lot of customers trading silver futures. There's the micro silver futures, which are much smaller than the big guy, and then you've got the silver, any sort of ETF, pick your poison. How do you like to approach the commodity space as an investor? As it's hard to get sort of that direct sort of exposure to something, even whether it's through an ETF or something like a futures contract. There's some nuances there, right?
Yeah, I mean, if you're buying through an ETF, for example, like you do have to worry about the curve, because you're not necessarily getting you're not getting the spot price, like the price that you necessarily see on the screen. If you're when it comes to silver, and to answer like Sue Sound Systems question, I've had a trouble with, because I didn't go I didn't personally want to go buy it when it was much lower, and now I'm sort of not sure about the direction of silver. I do think copper is more valuable in the kind of whole data center and industrial boom. Aluminum is another one. Rare earth metals is another one. And in Robinhood Strategies, we've been holding exposures to copper, not directly, but through company, and then rare earth metals through company and ETF actually, because we do think despite any volatility, these things are worth, kind of keeping investments in. And another one that we have, which is sort of a little bit of a hedge on what's the whole discussion we had earlier. And it's not really a metal, but it's more like helium. I think these things are important in chip making. So I do think if you believe in that trade, it's another layer of it.
Yeah, Mike, last point here, and then we'll say our goodbyes. But to a new futures trader, jumping into a product like silver, some very big size there. If we go back to that chart, when we go from 120 down to 60 in 1 or 2 trading sessions, that can make someone's life if they're on the right side of that trade, or completely wipe them out.
Yeah.
What advice would you give to someone that's sort of stepping their toe into the waters of a silver market, a gold market, a copper market, and as they apply what they would kind of normally do in the stock or options world, what are some of those nuances you have to really be careful about in 2 minutes, and then we'll say goodbye?
Yeah. One of the things that the futures market affords people who trade in it is the ability to control a lot of an asset with a relatively small amount of money. And when you're dealing with these things, there's 2 things I would encourage people to remember. Commodities in particular, their volatility goes up as the price goes up. That's typically not true for stocks. So that's a very different thing, and you need to be aware of it. Stocks, you see a lot of volatility when they go down. Commodities, the volatility rises with price, because usually you have these short-term supply and demand imbalances. It's one of the reasons you have that call skew in commodities that we were talking about earlier as well. The other thing is, understand the notional amount of exposure you're taking. So if you are using a future and you have that leverage, don't think about the amount of capital that you have at risk as the margin amount. Think about it as the amount of the asset that you're controlling. And on the upside, that can be a tremendous amount of risk. And you can see it in the price action. Both gold and silver, the volatility has been much, much higher of late. Same is true actually for crude as well. So think about your notional exposure, not your margin, your notional exposure, and anticipate that that's going to swing around a lot more, bigger magnitude, higher speed as price rises.
Yeah, we can bring up Legend real quick. So I want to point out where people can see this. In the snapshot widget, or I think we might have changed the name to the asset information widget, whatever you want to call it. Under your ticker, right, you have your normal summary, which gives you your daily stats. But if you go to contract specs, you can see what's, the margin requirement to trade. I'm looking at micro silver. It lets you know the multiplier. So $1,000, like basically every one point move. So this goes from 80.84 to 81.84. You're going to make or lose $1,000 on that contract. You're going to put up just north of $13,000 to trade this contract. So if you're new to futures, you're not buying X amount of shares at $80. You're buying one contract. You're putting up $13,000 in margin, but you're controlling notionally $80,000, we'll call it $81,000 worth of silver, and that leverage is basically 6x. So if you're a new futures trader, if you're dabbling, the leverage is immense. And if we went to the big contract, that goes to a 5,000 multiplier, and it's a much bigger contract. So, number one, start small. There's nothing wrong with trading one lots as you get your feet wet. Use stops, understand risk. And I've seen it before back in 2011, 2010-ish when gold and silver ran up. I saw customers trade their way to over $1 million and just keep piling on the risk because they thought the move would never stop. And then one big move like we saw can basically take all those gains out and actually put you negative if you're not managing your risk. So just my daily PSA for everyone.
May I share quickly a story about that?
Yeah, please.
Yeah, so I know somebody who runs a big platform, or did. He's actually moved on to something else, but he recounted the tale of a doctor who had taken an account with $300,000 in it, trading futures, to $33 million in 4 months.
Yeah,
and in the 5 months that followed, he took it down to 100,000.
Mm-hmm. Yeah, I had something very similar. I had
my
something
God,
very similar, not as big in numbers.
Take it and run.
I saw a customer once at an old firm take $50,000 in student loans.
Oh,
he traded silver up, what was it, in like 2010, 11 there, in that run up. Traded 1.4 million, Went long over the weekend. I think it was like 110, so like big ones, 110 contracts.
Fudge.
That Sunday night, May 1st, we announced that we got Bin Laden. Silver gapped down $5 on the open, and his account went from 1.4 million to minus 750,000 the minute the market opened. Our risk team, we closed him out, and he's like, well, I guess I'll ask my dad for the money, and his dad wired the money in. But the stories don't always end like that. But that's the thing you have to understand about futures markets.
Bulls and bears make money.
Pigs get slaughtered.
Yep. Thank you, everyone. Thank you, Mike. Good to see you. Thanks for taking the time. We know you're out in New York
so
doing some work for CNBC this week. And who knows? Maybe we'll have you back at Hood Summit this year. To everyone in the chat, it's always good to see you. Steph, I think we're just going to call this the monthly market update, and maybe we'll be back the first week in June, and we'll see where the market's trading at. Thanks to everyone behind the scenes, as always, our folks in the control room, compliance. Always happy to be on air with you guys. That's going to wrap up this one, and we'll see you next time. For Steph Guild, Mike Coe, I'm Michael Obusena. Happy trading. We'll see you next week.
Wow, that was good stuff. All right, well, that was awesome. Another great class from Steph, Obi, and Michael. 2 Michaels and a Steph. That was a good one. And awesome, we're also going to be getting this hopefully once a month, which is good. So I'm going to keep an eye out for this. And hopefully once a month I can be with you here and we can learn together. Steph and Obi and whoever they bring on are always just top-notch educational content. So looking forward to seeing you soon. I'll be live again Friday as well as Sunday. Maybe something in between if something interesting pops up. But I love you. I'll see you soon. And as always, stay safe, farewell, ahui ho, and I will see you on the porch.